Next, let us start with a new concept, that is degree of combined leverage, or it is also given a name as degree of total leverage. Dear students, so far we have understood that the degree of operating leverage measures the effect of the operational fixed cost. Degree of financial leverage is measuring the effect of financial fixed cost, and the degree of combined leverage will measure the effect of total fixed cost, that is operational and financial together. As far as the degree of combined leverage is concerned, it is calculated simply by using a formula as multiplication of DOL with DFL. That is the way the DCL is calculated. We understand that we may be provided with the information that the preference dividend is there or preference dividend is not there. If at all there is a situation wherein there is no preference dividend, if at all there is a situation like this, then in that case we understand that DOL measures what is the percentage change in EBIT for every 1% change in sales, and DFL measures what is the percentage change in EBT and EPS for every 1% change in EBIT. This is what we understand. So what will happen over here? We understand that this percentage change in EBIT is getting cancelled, and afterwards we understand that the degree of combined leverage is measuring what is the percentage change in EBT and EPS for every 1% change in sales. Degree of combined leverage is measuring what is the percentage change in EBT and EPS for every 1% change in sales, if at all there is no preference dividend. This is the effect of the total leverage, that is the total fixed cost which is introduced in the business. If at all we have been provided with the information about the preference dividend, then in that case again the formula is of course going to remain same. Percentage change in EBIT divided by percentage change in sales into percentage change in EPS divided by percentage change in EBIT. This is what we understand. In a way that the degree of financial leverage will be able to measure only the percentage change in EPS and not percentage change in EBT, if at all we have been provided with the information of the preference dividend. So if at all the preference dividend is given, then this is what we understand. So again what will happen? Percentage change in EBIT and percentage change in EBIT is cancelled, and degree of combined leverage is measuring what is percentage change in EPS for every 1% change in sales. This is what the degree of combined leverage is measuring. This is what we understand. Let on heading DCL, in bracket write down degree of combined leverage. In that write down first point, DOL measures effect of operational fixed cost. Full stop. DFL measures effect of financial fixed cost. Full stop. DCL measures effect of overall fixed cost, comma, consisting of operational as well as financial. Full stop. Second point, from basic information, comma, DCL is calculated as under. Write down the formula. DCL is equal to DOL into DFL. So multiplication of both of them is DCL. Third point, percentage change formula can be applied as under. If at all there is a situation of no preference dividend, and if at all there is a situation that preference dividend is given, in both of them we'll work out the answer like this. DCL is DOL into DFL. DOL measures what is the percentage change in EBIT for every 1% change in sales, into DFL is percentage change in EBT and EPS for every 1% change in EBIT. So what happens that the percentage change in EBIT will be cancelled. This is cancelled against us. And with DCL we will be able to measure what is the percentage change in EBT and EPS for every 1% change in sales. This is the way we can have a formula. At the same time, if at all the preference dividend is given, then in that case, how to calculate that I am writing over here. DCL is equal to DOL into DFL. DOL measures percentage change in EBIT divided by percentage change in sales. DFL is percentage change in EPS only. Why? Because this time the preference dividend is there, divided by percentage change in EBIT. So again the percentage change in EBIT is getting cancelled. And with DCL, we will be able to measure the percentage change in EPS for every 1% change in sales. This is what we understand. Consider following simple information. Information is given from sales to earning per share. From above information, you are required to calculate. First of all, you are required to compute the leverage, interest coverage ratio, and with that, say the further questions are there. I want you to calculate first of all answer of the first three questions, that is leverage. So friends, the first question is calculation of the DOL, that is degree of operating leverage. I am doing first of all a small discussion with all of you, that is contribution upon operating income. With that, say we can find the DOL. The second is the degree of financial leverage, that is EBIT is 1 lakh, EPT is 70,000, and importantly this time the information is provided to us even for the preference dividend. So we'll apply the formula accordingly to make the calculation of answer. Once we compute both of them, the combined leverage is only the product of both of them, that is operating leverage and the financial leverage. So answer of the first question, DOL, degree of combined leverage, that is found as contribution upon EBIT. The amount of the contribution is provided to us as example as 4 lakhs. The amount of the EBIT is provided to us an amount of 1 lakh, and the answer is 4. That is the first answer, DOL. The second is DFL. It is EBIT upon EBT minus preference dividend divided by 1 minus T. That is the way we make it pre-tax. The amount of the EBIT is 1 lakh divided by EBT, that is an amount of 70,000, minus preference dividend is an amount of rupees 12,000, and income tax rate is only 40%. Contribution for development of India, that is divided by 1 minus 0.40. So it is 1 lakh upon 70,000 minus 20,000. So it is 1 lakh upon 50,000. And the answer comes to 2. So this is the way, so the leverage is calculated as operating and financial. As far as the degree of combined leverage is concerned, it is again very simple to compute. It is DOL into DFL. So it is 4 into 2. That comes to 8. That is the way the DCL is calculated. Next question is calculation of the interest coverage ratio. So it is calculated using the information about the operating income, which is an amount of 1 lakh rupee, and the amount of the interest, that is 30,000. Using those two will compute the interest coverage ratio. Should I write down answer? Degree of sorry, interest coverage ratio. It is calculated as EBIT upon interest. What is the amount of the EBIT? 1 lakh. And what is the amount of the interest? 30,000. So answer comes to 3.33 times. This is the way the interest coverage ratio can be found. Next, the question says that if sales is increasing by 5%, calculate the revised EPS. Sales reducing by 3%, calculate the revised EPS. That is a question. Try to do answer on your own. So friends, over here information is provided to us that sales increases by 5%. And over here it has been given that sales reduces by 3%. So I am doing it together. Answer of question number 5 and question number 6. In that, sales increases by 5% and the sales is falling down by 3%. Right now the sales of the company is 6 lakhs plus 5%, that comes to 6,30,000. With the change in the revenue, even the variable cost will change. So it is 2 lakhs plus 5%, that is 2,10,000. Then contribution is 4,20,000. Next is the fixed cost. The amount of the fixed cost is 3 lakhs. Contribution minus fixed cost will give EBIT, that is 1,20,000. The amount of the interest is 30,000. Difference of both of them is earning before taxes, that is 90,000. Income tax rate is only 40%. Contribution for development of India, so it is 90,000 into 40%. That comes to 36,000 friends. Earning after taxes 54,000, that is 60% value, less preference dividend. Amount of the preference dividend is given as 12,000. That will give us earning available to equity shareholders, that is 42,000. Number of equity shares are 5,000. So earning per share is balancing figure and earning per share is A2P 40 paise, that is 42,000 divided by 5,000. That will give us A2P 40 paise. Please take down answer. Now sales reduces by 3%. So here 6 lakhs minus 3%. That comes to 5,82,000. Then 2 lakhs minus 3%. 1,94,000. Difference between both of them is contribution 3,88,000. Amount of the fixed cost is 3 lakhs. Operating income is 88,000. Amount of interest is 30,000. So EBT is 58,000. Now friends, honestly, there is no need to compute the tax. You can do into 0.6 directly to find earning after taxes. That is an amount of 34,800. We just compute the tax over here. It is 58,000 into 0.4. That is 23,200. Minus preference dividend is 12,000. So it is 22,800. Divided by number of equity shares 5,000. That is 4 rupee 56 paise. So it is 22,800 divided by number of equity shares are 5,000. That will give us the EPS. Now if somebody wants to do with the alternative method, then he or she can do working like this. For question number 5 and for question number 6 we can have working like this. Working note number 1, calculation of percentage change in earning per share. So we have working like this, DCL is equal to percentage change in EPS upon percentage change in sales. So percentage change in EPS is equal to DCL into percentage change in sales. We already have found DCL value. It is 8. So there are two questions provided to us. Question number 1 and question number 2. In the first question, there is an increase in sales by 5%. So 5% into 8, that comes to 40%. And so there is a reduction in sales by 3%. So what will happen? Negative 3% into 8, that comes to negative 24%. So first of all, we compute the percentage change in earning per share. Now working note number 2, calculation of revised earning per share. So we understand that, say again, there are two calculations. If at all there is an increase in sales by 5%, we understand that, so the revised earning per share is equal to current earning per share plus increase in earning per share. The current earning per share is provided to us in the question as 6. So that 6 rupees plus, we can see that over here there is an increase by 40%. That comes to 8.40. And if at all there is reduction in sales, by 3%, in that case what will happen? It is 6 minus 24%. 6 minus 24%. That comes to rupees 4.56. That is the way the revised EPS is calculated.